You're known as a value investor. What does it mean to be a value investor?
That is the $100 million question, because everybody defines it differently. We define it as for portfolios where we use a fundamental approach, so that's the analysis of financial statements, the interviews of company management, the assessment of the industry. To be a value investor is to pay less than the business is ultimately worth. And we give every company about 2 years to show us what it can be worth, and then we assess what that price should be 2 years from now. And if the price 2 years from now should be considerably higher than it is today, the stock is likely undervalued.
Now, the late Charlie Munger said that he changed Warren Buffett's views on value investing. Initially, value investing in Warren Buffett's view was buying something really cheap, even if the company wasn't great, but it's cheap. And Munger said, no, buy good companies, even if it's a little more expensive, as long as it's not overly expensive. And Warren Buffett allegedly began to do that. So what do? Do you buy really not great companies, but they're cheap? Or do you buy good companies that are a little more expensive and call that value investing?
Those two, and late Charlie Munger could simplify the most complicated of situations, but in a way it's neither. They may be in good businesses, they may have very few competitors, they may be in oligopolies, or they may be in an industry that's rapidly growing. There could be reasons why you call them good, but something may stop that. They may have a lawsuit levied on them, or they may have a scandal, or they may have a poor CEO who does a poor job of executing, and then they become bad. And that's when we like them.